Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. This Analyze Out Loud video is going to take a look at PepsiCo, looking at several different metrics as a long-term dividend growth opportunity. As I stated in the written portion of this presentation, PepsiCo is a company that the market has historically valued at a high valuation. This dark blue line on this long-term graph represents a blended PE ratio of 21.7. So you can see anywhere I touch the line, it's a PE of 21.7. And Pepsi stock price actually traded at a higher multiple of adjusted earnings back in the irrational exuberant period. It tracked that 21 multiple very closely. Then the recession brought it down to its theoretical fair value of a PE of 15. I would consider this a reasonable valuation for a company growing at 7.4%. But having said that, I don't argue with the market either. And by looking at this graph clearly, the market has valued the stock at a premium valuation to that theoretical intrinsic value calculation of a PE of 15. Now, having said that, recently Pepsi stock price has fallen, although it did recover about 7% since it hit the very bottom, but it is currently trading at a blended PE of 19.8, which is moderately below its normal long-term PE ratio valuation. However, looking at earnings is only one way to value a company. Another way, since this is a dividend payer, I'm going to look at its historical year-end dividend yields. These are year-end dividend yields. Last year it was yielding 2.6%, and you can see the valuation was higher than it currently is. Its highest dividend yield was December 31st, 2012, where it was yielding 3.1%, and you can see the valuation was low. It also offered investors a starting yield of 3% by December of 2008 at the bottom of the recession when its valuation was really low. So a couple of things have happened. We currently see 3.4, which is higher than its historical norms, as I've just shown you. But there's another factor here that I also want you to notice. The dividend yield is a function of valuation and payout ratio, really. And what's happened is Pepsi was paying out 35, 40% of their earnings. Then they were paying out 45, 50 in 09, 010. Then they got up to 50%. But the last 3 years, they've been paying out approximately 60% of their adjusted operating earnings. So what's happened is we've had an increase in the company's payout ratio. As you can see, the area below this white line is the dividend payout ratio. You can see it graphically here. So the company's payout ratio has increased and its valuation has gotten better. Therefore, we now have a dividend yield of 3.4%. A couple of fast facts about the company. Yesterday closed at 107.61. Its adjusted operating earnings growth rate going back to 1999 has been 7.4%, and that's pretty close to what analysts are forecasting going forward, by the way. It has an A+ credit rating. It does have 67% debt to capital, but it's a very high quality company that has increased its dividend for over 46 years. If you look at just what I can graph here, since 1999, its average dividend growth rate has been over 10%, and its compound average growth rate also been 10%, although more recently the dividend growth has been lower at 9%, 7%, and 7%. So clearly, PepsiCo is a dividend aristocrat with a great long-term dividend growth rate. So let's value it looking at a couple of other metrics. Since this is a dividend stock, I like to look at operating cash flow. And what you're going to discover here is that Pepsi's correlation to its operating cash flow, its price correlation to operating cash flow, is much more well-defined or a much tighter fit than you saw with the adjusted earnings before. A couple of things that this particular valuation reference points out. I want you to notice operating cash flows have been dropping a little bit in the last couple of years and are expected to be down again this fiscal year at around 9% before beginning to rise again. And what's interesting about this is that you can see how Pepsi stock price has tracked that cash flow, and you can see periods of misalignment with valuation, high valuations here, low valuations during this period, and currently I'll call it a fair valuation. But I want to show you something very interesting. Your long-term rate of return will always be a function of two components, the growth component and the income component. But valuation also plays a role. So I'm going to use my scroll bar here, and I'm going to bring PepsiCo down 1 year so that we're starting with a fair valuation of 15 times price to operating cash flow, which is their historical norm. That's the dark blue line on this graph. And then I'm also going to scroll back a couple of years here. And what you're going to see now is over this period of time, which ranges from fiscal year 2000, which is also a calendar year for PepsiCo, through fiscal year 2018. So we have a little forecasting here. but the operating cash flow growth rate is 6.2%. Now you can see the company started at fair value and it's ending here right now at just slightly over fair value. So what you're going to see is that the capital appreciation component of total return is going to very closely correlate or relate to that 6.2% growth. So I get down here to the performance report, and what we see very clearly is the capital gain has been 6.2% because valuation started aligned. It was also aligned at the end, and the company's operating growth has averaged 6.2%. Now, we also got a substantial amount of dividend income over that period of time, multiples of what the S&P or the average stock would have generated. So you ended up with a 7.7% rate of return since calendar year 2000 compared to only 4.6 in the S&P 500. So this is an above average stock over the long run, and it's obviously going to be a function of valuation plus earnings growth plus dividend growth that's going to give you your total return going forward, which I'll talk about a little later. However, since the dividend is so important in this presentation, I'm going to take price off of the graph, and I'm just going to look at operating cash flow relative to its coverage. This white line is the company's dividend. As you can see, it's increased every year. The payout ratio you can see has increased as I illustrated earlier, but the point is there is ample operating cash flow to cover the company's dividend. However, in addition to looking at operating cash flow, when I'm looking at dividend coverage, I really like to focus on free cash flow, which is what's left over after running the business, the amount of money the company would have and able to pay the dividend. As you can see, PepsiCo generates ample free cash flow to cover their dividend all these years. And by the way, it also relates to the amount of debt. The company also has the ability to amortize its debt as a result of both strong operating and free cash flow. Once again, though, there is a negative free cash flow, which most are attributing to things like the changing in the patterns of people purchasing sugary carbonated drinks and salty snacks, etc. But as I indicated in the written portion, PepsiCo is working to turn that situation around. Nevertheless, they have ample free cash flow. Next here, I'm going to take a look at PepsiCo based on EBITDA, or earnings before interest, taxes, depreciation, and amortization, which is really another form of cash flow in my mind. So I'm going to put market price on here, and I want you to see that just like you did with operating cash flow, you see a very high correlation. This company normally trades at a price to EBITDA of about 12.1, which is the orange line on this graph. It's 12.1 times EBITDA. Now you can see the period of low valuation was really a great time. Anytime you can find a stock as quality of Pepsi buying at a low valuation, you can see that your rate of return is going to be significantly better than had you bought it at a high valuation. Here we bought it when the price to EBITDA was 8.5, and we ended up at an 11% rate of return. If I bought it at its normal price to EBITDA or just slightly above it, as you see here, the rate of return goes only down to 7% a year. So valuation coupled with growth, coupled with dividend income, are going to be the keys to how much money you actually make and how successful you're going to be as an investor in the stock. And as I said in the written portion, Pepsi isn't dirt cheap today, but it's certainly attractively valued, because had you bought it at valuations similar to what it is right now, here's the price to EBIT of 11.8 in September of 2002, which is precisely what it's at right now. Had you bought it at that price to EBITDA, you would have averaged over 8.7% annualized, and for a blue chip over this time frame, that's an excellent rate of return. Next, I want to look a little deeper under the hood, and I'm going to go into financial underlying numbers, what we call fund graphs. And I want you to look at Pepsi's long-term gross and net profit margins here. You can see the margins on this stock have been very stable. They did weaken a little bit in 2017, but they generally generate 50+% gross margins, and they generate 10 to 11 or 12% net margins, even as high as 14. However, their net margin in 2017 was 7.65%. And as I mentioned, this changing consumer taste has also had an impact in the shorter run here. Pepsi's net margins have been virtually non-existent the last couple of quarters, although they are still generating gross margins. But as mentioned earlier, they are working hard to fix that. Additionally, PepsiCo generates very high returns on equity and very solid returns on invested capital, and those have actually been improving slightly in recent years, although again, return on equity was down a little bit in 2017, although still very strong. Taking a look at their balance sheet, I think there's some very interesting strengths that show up in their balance sheet. First of all, the company's cash and cash equivalents are over $10 billion through December of 2017. Furthermore, if I look at the last quarters, you can see March of 18, they had over $13 billion in cash. Their cash went up over 27%. So the company does have financial resources. Furthermore, as I alluded to earlier, their debt has gotten a little higher than historical norms. The blue line here is long-term debt. The mustard green or yellow is total debt. And as you can see, most of their debt is long-term, and they have increased their debt significantly as the company is going through and doing a lot to resurrect their business and create new products, etc. Nevertheless, operating cash flow and levered free cash flow are more than adequate to continue being able to amortize their debt as well as raise their dividends going forward. Now, I'd like to conclude this Analyze Out Loud video by looking at what analysts expect for Pepsi going forward. As I briefly mentioned earlier, analysts are expecting Pepsi to continue or to grow over the next couple of years at an average growth rate of about 7.6%. There are 24 analysts that think this fiscal year we're going to see earnings growth of 8.99% by the end of 2018, followed by 6.8% in 2019, followed by 7%. However, for 2020, the number of analysts drop off from 24 and 25 down to 15. Nevertheless, this would indicate double-digit rates of return going out to these different time frames had you bought Pepsi now based on its normal price to operating earnings. I also would like to point out very quickly that the analyst scorecard for this company has been impeccable. The analysts have met or beat estimates 100% of the time when they were with a 10% margin of error for 1 year forward and 100% of the time with a 20% margin of error for 2-year forecasts. So that gives me some, let's say, comfort that these estimates might be within reasonable ranges of being correct or accurate. Next, I'd like to look for forecasts of operating cash flow, and I'm using here the 15-year normal priced operating cash flow. You can see it's been about 14.8. They are expecting, as I mentioned earlier, operating cash flow to be down, so there is some short-term risk in investing in the stock, but as operating cash flow is expected to increase going forward. Now, there are very few analysts even forecasting operating cash flow, but the long-term growth, or the growth, is expected to be 7.9%. The 3 to 5 year growth is expected to be about 7%. So when you're looking at operating cash flow, there is a little bit of short-term concern, but longer term, the company looks real good. And once again, we see analyst scorecards that tell us that the analysts really have a good handle on forecasting this company, probably as a result because Pepsi also gives good guidance. Anyway, I consider Pepsi a reasonably priced stock right now. It's not necessarily cheap, but it's not overvalued any longer. The 3.4% dividend yield with the higher payout ratio is very attractive. It's an extremely high quality company. And for those looking for modest capital appreciation with some above average current dividend yield, you might want to take a closer look at Pepsi. This has been Chuck Harneville saying thanks for watching.